Mr. Nick Charalambous, welcome to the podcast.
Thank you very much, Dan.
You had a relatively comfortable drive up from Cork today.
Yeah, 2.5 hours from door to door, so it wasn't too bad.
Not too bad. And I was laughing, I was saying to Nick there, the power cut about 20 minutes before Nick arrived, and I was having a panic running around trying to find backups for the podcast and stuff, but luckily it came back on. So we have our lovely video now as well today. But thank you very much for joining me. Anybody who listens to this knows that the main kind of driver for me with these podcasts is to empower my listeners, to give them usable information. So with yourself, we're going to dive straight in here from the start. No fluff. First of all, I'm going to ask you maybe to give us a little bit of background on what it is that you do with your company, Alpha Wealth, and what led you on your journey to get into this side of business, if you don't mind.
So I set up Alpha Wealth 9.5 years ago now, and it happened more by chance than design. I previously would have worked in personal finance and as a wealth manager, primarily with banks. So my sort of backstory is I moved to Ireland back in 1999 to Cork, which is where I live. Started out with AIB as a kind of a junior financial planner, and I kind of learned the ropes. Did a small stint in Dublin, kind of on a training program, having worked previously in investment banking. So it was a complete departure from what I was used to. I really enjoyed talking to people, face to face, helping them out with their sort of personal financial situations. And then it sort of progressed from there. So I worked my way up through the different echelons into kind of wealth management. And then more recently, I would have worked in an accountancy practice, which was a really good insight into just getting a lot more in-depth into kind of tax planning, helping people understand a bit more about their pay slips, the tax they pay, tax reduction schemes, and really kind of, getting a bit more into that area. And then this was kind of post the recession of 2008, 2009. And then felt that, it was something that I wanted to kind of move into myself. So it took a while just to get the relevant regulation. It's a very heavily regulated industry. And then, as I say, back in sort of late 2013, we set up Alpha Wealth in Little Island in Cork. And we've subsequently kind of grown steadily every year since, thankfully.
Brilliant. Amazing. You mentioned a phrase to me that I rarely hear, I was familiar with, but rarely hear, and this idea of financial wellness or financial health, I suppose. Yeah. And when people see the title of this podcast, I might be a little bit confused because it's a little bit out of what I would usually go down. But realistically, if you are under financial pressure, if you struggle with financial literacy, if there's any sort of financial issue in your life, which for most of us there probably is, that's a source of stress, and stress can have a direct impact on your physical and psychological health. So from a financial wellness point of view, was that a big driver for you getting involved in working with people, like you mentioned, with pay slips and understanding their money and stuff like that? Was that a concept that you were kind of actively thinking about when you went down this road?
Yeah, so for me, having been on the journey myself, and obviously having moved from London, which is where I grew up, to Cork, and having to reinvent myself, and I was unemployed for 6 months. And that in itself was a difficult, transition to go from what was a well-paid position to essentially being unemployed. And I was staying in my kind of mother-in-law's house on a couch, so I can tell you,
it's a familiar story to many people.
So, what I would say to all of the listeners is really where we like to think that we can help people is by what I call helping them achieve financial independence, and that looks different for everyone. And we all have our own personal journey, and without sounding too holistic, despite the fact that some people may be in financial difficulties, some people may be paid very well and not seeing the kind of fruits of their labor. But what we're trying to do is say to them, look, you need to sort of understand where you are now and let us help you do that. But more importantly, set out these kind of roadmaps or objectives, as I call them, as to what you want to try and achieve. For some of my clients, they want to basically not have to work beyond the age of 60. That tends to be one of the main kind of criteria that most of the people that we work with are looking for, myself included, I might add. And I mentioned I'm 50 later this year, so I have 10 years really of...
Ladies and gentlemen, this man look 50, not at all.
So in terms of, how we can help people with that and how can we achieve it is setting out this goal. And it's like anything. And we spoke earlier about kind of fitness and, I suppose, doing some training. You just apply yourself. You need to set a program and you need to just apply it. And we speak about, helping people achieve objectives like buying a property to helping their kids through third level education. And financial independence for me is very, very simple. And you might say, well, Nick, okay, how does it relate to someone in their 20s versus someone who's in their mid 50s? Because it may look very different. And obviously, there's a lot of different objectives that both sets of people may have. And in essence, what it is that it's getting to a position where you don't have to work for financial being. And what I mean by that is that you have this kind of passive form of income. Typically, it's no debt. So we help people try and obviously pay down the debt that they have, including a mortgage. So, we have to be cognizant of the fact that that is sometimes a very large liability that people have. And some of the work we do is just helping people. We don't provide mortgages directly. We try to remain independent as best we can. It's not an area that we feel that we're focused enough on. So again, I'd like to think as an independent provider, we can help people understand like their mortgage situation. If they're on a tracker, does it make sense to stay on the tracker or move into a fixed rate? And what are the options that are available to them? But it's about, I talk about it like an elephant in the room, and how's the best way to kind of eat it is one spoon at a time. So, we help people just break down what they want to achieve and compartmentalize. I talk a lot about helping people understand about the short, medium, and long-term objectives. So most of the listeners that if I was to speak to, say, depending on what age you are, depending on, what stage you are in your financial life cycle, the simplest takeaway I can give today is say, do a financial budgeter. It's a very simple exercise. It doesn't take very long. We have one available on our website. There's a lot of free tools that people can access. You may be doing something similar yourself, and some of the online banking apps provide this as well. And it's about just sort of saying, well, we know what you earn, your net pay, obviously. You need to understand about what you're spending your money on. And then it's a case of just managing that. And in terms of what's left over, I call this reframing, but about trying to save into things short term, which is anything less than 3 years, medium term, which is 3 years to that age of financial independence, which we've notionally set at 60, let's say, for most individuals. And then obviously longer term, which is primarily talking around the dreaded word pensions, which again, it doesn't have to formally just be about pensions, which may be one part of the overall puzzle, as I call it. There may be an investment property that provides this passive income source that we mentioned earlier.
Okay. There's a couple of phrases you mentioned there which I find very interesting, because over the last maybe decade or so, a lot of people mention financial freedom or financial independence. This idea of passive income is another one, and it's all kind of packaged in this, I suppose you could call it this hustle culture, kind of people looking to be completely independent and not need to earn any money and have multiple sources of income that don't require the direct input. But what are some of the more common areas you find that people really, really struggle with the people that you would work with?
So the main one, and I refer to what I call a menu board. So for most people, they kind of have a sense of what they're supposed to do, that most people know that they probably need to sort of have a pension of some description outside of the state pension, because the state pension, as most of us know, currently pays out from the age of 66 onwards, which may be deferred to 70, God help us, in the next few years. But also it pays an income of about 13,000 a year. So, I suppose, at a high level, we kind of realize that may not be enough to satisfy our requirements. So obviously having a personal pension or a company pension scheme, if you're a member of a company, we should be availing that. But then it's saying to yourself, well, okay, how do I fund that? And what's the best way of funding that versus the other objectives I have? So for example, there's people that want to help their kids through college, and there's people that want to go away on a nice holiday every year. So how do you distribute, what you have available? And that's the biggest part of what I think we do as financial planners, is helping people find the right balance. It's that sort of tweaking. And then we spoke earlier, Dan, about being adaptable. Yeah. The biggest thing I can say to everybody is have a financial plan, but make sure that you're able to adapt that. And this is where I think the most important thing for any individual is, once you have that plan set out, is to check in on it at least once a year, so you can see where things have changed. Has there been a change of, income? Did you get a pay rise? Did you get a bonus? How was that utilized? Was there an addition of a family member? Did you have a baby? Did you get married? Did you get divorced? And all of these things have financial impacts that we just need to adjust for. But again, you kind of stay on the pitch, but sometimes the goalposts move, and you just have to make sure that you shift your position accordingly. And that's the main focus really for what we try and do.
Yeah, it's fascinating to me. In my experience with not all of my peers, I suppose, but a huge number of people that I would interact with, there's one kind of big picture view on money. This is how much I earn in a year, and this is roughly how much I spend in a year, and that's kind of the bottom line when it comes to financial planning. In your experience, I know you're involved in the industry, but in your experience, do most people have any deeper layer of detail, the vast majority of people inside the bell curve, when it comes to their financial planning? Or are most people raw and they have very, very basic and limited understanding?
A lot of the people that we engage with, they tend to earn reasonable amounts of money. So, we talk about kind of the average wage in Ireland being somewhere in the region around 40,000 a year, let's call it, which is the actual amount that you start paying tax at the higher rate, which becomes relevant to, making sure that you're trying to reduce the tax that you suffer, which is another area that we try and help our clients with. The key thing is that, unfortunately, as people earn more money, the tax man takes a larger cut of that. So, typically, anyone who's earning, say, 50,000 a year, for every 10,000 pay rise that they get, they pay 52% of that to the tax man, and it starts to hurt more and more as they get paid more, which is something we all try and strive for. So to answer your question, really, some people have a sense of the fact that, they try and plan, but they probably don't necessarily always plan effectively. And it's the outside look that helps them to understand maybe things that they're not doing. And it's very easy for me as a financial planner because I don't hold that kind of, I suppose, I call it kind of anchor bias, where somebody does something because they're used to it. Some people like saving in the credit union because they're used to doing so, even though, with the greatest respect to the credit union, and it suits that short-term segue that I spoke about. But if you're trying to save into the long term, into the credit union, it's not particularly sensible, because unfortunately inflation is your enemy and it's going to erode the savings that you can earn. So it's about having the right vehicle for what your intentions are.
Okay, yeah, that's a very interesting point, and it's particularly relevant, I feel, in Ireland, because there's a lot of, we do this because it's the way we do this. This is how we do things, and this is how my mom did things, and so this is how I do things. But as we spoke about before the podcast, things change so much right now, which in one way can be a little bit frightening and overwhelming, but another way offers massive advantages, options, opportunities. I mentioned I've read a couple of finance books, but nothing really stuck. But we talk about the likes of Rich Dad, Poor Dad, and understanding this concept of money is something that you can leverage. And if it's just like this, to focus on the savings piece, if you're trying to save your way to financial independence or financial freedom without a really solid plan, it's a very, very difficult thing to do, because we have things like lifestyle creep and inflation, and your money is literally devaluing. And it took me a while to understand that, because you're told save your money, and that's how you take care of yourself. But actually, if you're smart with your money and you leverage your money, you use your money, it's a much, much better way to do it. But I think, and I'll speak for myself here as well, there's a lot of fear around that. There's a lot of uncertainty about, like, what do you mean use my money? Where do I put it? Do I invest? Do I put it on a horse? Do I invest? What's a good investment versus a bad investment? I won't jump into investments just yet, because the whole section I'd like to cover with you on that. This concept of people earning good money and really struggling, the first thing that jumped out to me there when you were speaking is the figure people usually think about when they think about how much I earn is their gross income, which is not how much money is going into their bank, which is, again, like people say, I earn 40 grand a year, I earn 80 grand a year, whatever it might be. But that's not necessarily what you earn, because the tax man, as you said, take his cut. And I have personally seen a lot of people get caught in the trap of, if you're in an industry where it's a kind of a linear growth, or you're on a ladder and it's 10, 15 grand jumps over 4 or 5 years, whatever it might be. With inflation and with the increase on tax that you're going to be paying on that money, you're just caught in this endless cycle of never actually achieving, and your lifestyle becomes more expensive as you get older and you have more responsibilities and a house and another car. Very quickly, you could see how that could become a trap for people who have a really good, solid job and eventually end up really struggling.
Absolutely, Dan. And this is really the thing that we're finding more and more of. We're coming across more people that are paid well on paper and can't quite understand why they're not seeing, the benefit of these pay increases. And again, we try and help people just to understand. So, I look at the first thing we do is kind of look at people's pay slips and say, okay, let's see what deductions are there. And sometimes there's things that they don't even realize. Like, sometimes people have the benefit of health insurance through their employment, not realizing there's a benefit in kind. You might think, well, what's the relevance of knowing that? Because surely it makes sense for them to avail of it. And in most cases, it would do. But sometimes there's choice of plans. So I say to them, look, do you have options within your employment? Can you go for like a gold, silver, and bronze type? And which one did you nominate? And most people probably take the most expensive one because they think it's a free benefit.
Yeah.
So it's little nuances like that, and just seeing, like, understanding the payslip, understanding why your net income varies from your gross so drastically. And it could be just down to the tax, but it can be sometimes down to other things. I've come across clients that, for example, haven't claimed back on, the Med1 form over the last 4 years, or indeed any kind of stay-at-home expenses that we're all entitled to, particularly during COVID. And these are simple things. Okay, they're simple for us, but
Simple when you know
maybe they don't understand. But like getting familiar with the ROS system, this is the revenue online system.
Yeah.
We say to people, look, let us help you. We send you the link. We show you how to click onto it, how to register for things. Anyone who's renting in Ireland, there's a €1,000 rebate that's is available to you. And yet we still come across people that are renting that haven't availed of it. And we say to them, look, this is €1,000 that is there for you. The revenue want you to take it. You just have to apply and go get it. And this is how you do it. So there are sometimes some kind of what I call silver linings. It's not necessarily all bad. And I think, if people can sort of understand the fact that, there are sometimes reliefs available to them. You spoke earlier about, buying a property, and there are schemes available to help people, because unfortunately, like that, sometimes people get into this trap of, they can't save a deposit for a property, and yet they're paying high rent, and that prevents them from saving for a deposit for a property. So it is this vicious cycle. And it's just being able to help them understand about how they can sort of break that. Are they eligible for, say, the Help to Buy scheme? And is there an opportunity for them to, say, move directly from a rented property into buying a property without necessarily having a deposit for that? And a lot of people won't necessarily always know that that's an option that's available to them. So again, it's about giving them just, independently this kind of information that may sort of make a complete drastic change in the way that they're thinking and the way that they're behaving to reach, as I said, their objectives. And it's important to understand what their objectives are.
Yeah.
Different people have different views as to taking on debt versus taking risk in their investments and so on and so forth.
I'm just going to make a little note here so I don't forget something I'm going to ask you after I ask you this first question. There's lots of stuff coming up for me here. First of all, would you mind just explaining for people this lovely little phrase, benefit in kind? Because the first time I came across this was when I was running my business, and it was like, potentially you could buy a company car. It's like, a company car would be fantastic. What's this BIK number here? Wait, hold on. This makes no sense to buy a car. Would you mind explaining benefit in kind for people who might not understand?
So essentially, revenue, if you receive a benefit from your employment, would look to tax you on that. There's no real free lunch.
People in there.
Yeah. So typically they're manifested for most people through things like if you get health insurance, as I mentioned earlier, or if you have a company and you try and get your company to pay for certain things, including a company car, with certain exemptions. Obviously if it's a commercial vehicle, typically it won't be treated for, but in the most part, there is benefit in kind, and unfortunately those rates changed significantly since the start of this year,
wasn't it? And electric vehicles as well, wasn't it?
Yeah, they're reducing the benefit on electric vehicles, which is really unfortunate, because those people that rushed out to buy an electric vehicle to try and avoid the benefit in kind will find over the next 3 years that they're not going to receive much benefit, really, which is really difficult pill to swallow. But so essentially, benefit in kind is a tax, and it's a tax on a non, I suppose, financial benefit you receive from your employer, where you don't physically get the cash. So like that, it's typically things like health insurance. There are certain things that you can benefit from, such as, death in service benefit and income protection through your employment. And again, if those things are available, it's important to understand them, because what we have found, and I spoke earlier about, making sure that people are not overspending, because that's sometimes a fear as well. I find when I come across talking to individuals, most of us probably pay for things that we shouldn't really be. And I know it sounds a bit odd, and you might think, what do you mean by that? You pick up kind of things during the way. Like, I've come across clients that are paying for mortgage protection insurance on a house they don't own anymore. and it's a direct debit they forgot to cancel.
Okay.
And the bank weren't going to really be jumping and screaming saying, you need to cancel this. And it's rife, and I say to them, look, the reason why we ask you to do this financial budgeter and share it with us, or, share it with somebody, but is to get that kind of outside looking in and say, well, hang on, why are you paying this premium? These products, and I mentioned earlier that I worked in the banks, we were the people that once you got your mortgage approved, you were rolled into, and we were told to try and sell anything we can possibly sell to you. Now, okay, it wasn't maybe quite as blunt as that, but it sort of was. And, you played on fear, and you also then, suggested things. And because people felt that they were getting a mortgage from the bank, they couldn't really say no to, So mortgage protection is one product that it's a life assurance when you buy a property that you're forced legally to take out. But there are different layers of that. There are expensive options and there's less expensive. And because of the commissions in the industry, people generally tended to push the more expensive ones, including things like serious illness benefit. And then they used to provide income protection in addition. Now, I'm not saying that these are bad products, and I'm not saying that they're not relevant to everyone. But when someone's taken out probably the biggest loan they're ever going to take out, and they're going to be faced with a lot of expenses coming down the road, it's probably not prudent to be taking on an expense that you don't really necessarily always need. And certainly not a time when you're kind of weak and vulnerable. So I say to them, you need to check in and understand that if you're paying, over €25 a month, for example, for mortgage protection, generally speaking, I think that's too much that you're paying for that. And I prefer for people to strip out their costs and understand and recognize exactly why they're doing something and be very focused on the fact that it's for a specific purpose.
I'm delighted that you finished with that, because it really sums up. There's a question I'm going to ask you here now, not to go too far off in the weeds, but I constantly talk about this as a concept. The entities out there who are providing services which make our lives very, very easy, and they really facilitate us buying houses and having nice things and health and all that kind of stuff, they're not necessarily just there for our sole benefit. These are entities that make money and they have boards and they need profit. And so there's a dance to dance there, and you explaining to me that there are costs I can strip out of my life that will help me to empower myself and have a better life. You're not saying to me I shouldn't trust X, Y, and Z and a big bad man is out to get me, but you're explaining to me that there are things that I can do that will allow me to live a better life for myself. That's not a message that we hear from, for example, the bank. And again, I'm not having to go at any particular bank or anything like that, but we just assume that if this is the way, like we said earlier on, if this is the way it's always been done, this is what I have to do. And if I get a mortgage, if this man who seems to know all of the numbers and figures and has a very nice suit tells me that I have to do this thing, I have to trust him, because I don't know. And I'm at a complete disadvantage here. And we mentioned Rich Dad, Poor Dad earlier on. Another book that was very important to me that I read was not a finance book, was Freakonomics, because there was a concept in that where they talked about this imbalance of information. And if you have more information than me, you've power over me.
Absolutely.
I saw it in the health industry, because obviously you're terrified if the doctor says something to you, you're going to trust everything that person says. And again, not an issue with doctors, but they don't necessarily know everything about you or have your best interest at heart all the time. They have other considerations there when they're dealing with an individual. So do banks, so do all organizations. So it's my responsibility to speak to you or empower myself. And the fact that you can give me that information and you willingly help people with this is fantastic. But there is an element of fear-mongering there.
Absolutely. And even just going back to, mortgages and not to get sidetracked, but I say to people, again, because it's an area that we don't provide directly, if you're looking for a mortgage, in my opinion, it is better for you to talk to a mortgage broker rather than directly to a bank. And the reason for that is that obviously you're getting essentially all of the banks in at the same time when you're talking to the mortgage broker. And therefore you need to be cognizant of understanding that there are different rates for different banks. Certain banks would suit certain types of individuals. Particularly given the rapid rate rises that we've seen over the last year or so, that there's a massive savings opportunity. But unfortunately for some people, because they're maybe used to doing things a certain way, and again, it's through life. I mean, most of my clients generally would have a broad understanding of the concepts of what we say. We tend to be time poor when it comes to this thing. It's interesting, I was listening to a kind of an interview earlier, and it was just talking about the way that banks are now, reacting to people, and we spoke briefly about AI, but these online apps now, they're starting to sort of filter out and understand what people are looking for, and they're making it much more, convenient for them. And it's interesting. They're almost like kind of shaping their spending habits because they're used to a way that people used to do things. It's really interesting. But so, look, I totally agree with you, Dan. Unfortunately, there is always going to be this kind of information imbalance. And the key thing, again, just to stress to any listeners, making sure that you're getting this kind of, I suppose, independent advice, but also being able to quantify it, and again, look, I'm not saying that people need to ring and ask around 5 different people. Sometimes you don't get the luxury of doing that. But as long as you can sort of at least verify that, you have the right things. But as a general kind of rule, I'd say typically I find a lot of people are carrying too much protection. Why do I say that? Because like that, we're sold these products and we're never, undersold them. So, and people's lives change where, we may have sort of started out life where, we had a job where we didn't have protection within that position. We move jobs, we get death in service benefit where like the employer will pay our estate, say 4 times the salary that we're on, but we haven't adjusted the protection that we had previously. So this is why it's always interesting. It's not that these things necessarily were always incorrect. It's just they can become defunct by virtue of the way that we change. Okay. So for any business owners, for example, and again, I set up this business Alpha Wealth 9.5 years ago. It totally changed my spending because there were certain things that my business could pay for, legitimately, by the way, including certain protection needs. So the only protection policy that I would suggest any business owner should be paying for themselves personally is mortgage protection. This is the loan that they have on their private residence. Everything else can be borne by the company. So sickness benefit, income protection, life assurance. And there's no benefit in kind, and it's a tax-effective policy for the company. It's one of the advantages of having a business in Ireland.
Yeah.
There's not too many of them, but that certainly is one of them. So again, it's an understanding, and sometimes people are slow to change. That's the other thing, that because, I come across clients, I met clients there a week ago where they had an insurance policy. Now, the policy in itself was reasonably okay. It wasn't discounted, it wasn't the lowest cost, but intrinsically, it wasn't a misappropriate policy for them. But they weren't giving themselves the affordability to put money into savings and pensions. And I talk about living benefits. These are things that are definitely going to happen. They're going to need the money for savings. They had 3 kids and they wanted to try and put some money aside for further education for them. And also, they're going to retire. You hope that they'll get to that point. Whereas the protection in itself wasn't the most fundamental objective they had. So again, I was just trying to help them understand and piece together the right mix between them, Yeah. And sometimes it's about that, it's finding that right balance. And again, it's always this check-in, as I refer to.
And it is, you mentioned to me again, but it's similar to a fitness journey or a business growth journey. Unless you can identify your objective and your outcome, there's no real direction to what you're doing. It's just kind of a general month-to-month, day-to-day process, as opposed to, right, this is what we're trying to do. We can formulate a plan because now we have an objective. With no objective, it's very hard to have a plan.
Absolutely.
Yeah. You mentioned debt earlier on, and I didn't think I was going to touch on this because I'd forgotten about it, but a very interesting topic. Debt usually sounds negative, but there are obviously some ways that debt can be managed to be positive and can facilitate a better life in the short and medium term. How does debt work as a concept that's not purely negative?
Yeah, so I mean, in general, we help our clients understand about the debt that they have. And, I come across clients that have car loans, and I talk to them about the loan in its own right. And typically, let's just say, on average, a car loan might cost you 7-8% of interest. And then there are certain types of car loans like PCP and 0% finance, if you can be lucky enough to come across one of those, if you happen to like a car that the particular dealer is offering for a period. But what I would say is, it's not that I intrinsically don't want people to have that. I mean, if you want to drive a nice car and you cannot afford to drive a nice car, then yes, ultimately you may have to take out a loan to afford yourself that luxury, as long as you do it consciously. Now, where it becomes relevant is that I suppose, in lieu of that, if you have excess savings and you're then coming to me and saying, Nick, I want to save. And then we're looking at the car loan and saying, but if the car loan's costing you 7%, and bearing in mind, if you save money with an institution, and there are some savings plans out there, I spoke about short, medium, long term, anything over 3 years, there are definitely options available to people where they can earn reasonable rates of interest. And this effect of compounding, you talk about rich dad, poor dad. It's a very, very powerful concept of, obviously getting a return of interest. And because it compounds over time, it grows very, very well. But the relevance of the car loan is that in a lot of cases, it makes more sense to pay down the car loan before you embark on savings, because the return of investment is much greater. Bearing in mind, if you save money in any type of savings vehicle, the taxman's going to want to get a wedge of that interest that you earn. So you're looking at the car loan, and I see a car loan then of 7%, in effect costing about 10%. That's the equivalent rate that you need to achieve in another savings vehicle.
Okay.
And if I came to you today, Dan, and said, Dan, okay, you've got a car loan, you wanted to discuss savings today. I have a fantastic savings plan. It is risk-free, offering you 10% per year immediately. You take my arm off.
Yeah.
And I express it in that way to explain to people how much the car loan is costing them. And then we focus on paying down that car loan, very progressively. And then we get onto the structure of savings. Now, again, it's all balanced between, obviously, again, certain objectives they may have. Because if you've got a more pressing objective, which is you want to pay for a holiday that you're committed to, then, of course, you're going to have to keep some funds aside to do that. And it's getting the mix right. But and conceptually, on this menu board, as I keep going back to, you just try and prioritize, and you work on trying to get people to understand about how they can prioritize best for what they want to try and do. Time generally tends to be the healer, by the way. I feel that for a lot of people, I believe firmly, everybody can achieve financial independence. And you say, well, hang on, how can you say that when some people are in sort of serious debt? Now, it may take a lot longer for them if they're in that position. But again, it's about them understanding, like, what does it necessarily mean for them? I had a client, actually a GP, believe it or not, based in Kerry, and they started a pension at 60 years of age. And they said to me, was it too late? And we spoke about, other assets that they had. They had an investment property. And it was interesting just to sort of piece it together, what they could accumulate in 5 years, which was kind of typically when they wanted to draw it down. I said to them, look, we have a plan now, but that pension is now just a medium-term savings scheme for you. But you get this great benefit from the government. And conceptually, they could understand then that this still made a lot of sense for them, even though in their own minds they had left it too late. And was it really worthwhile? So it was just interesting. But, I really enjoy the discussion because it's different for everyone. It really is. And it varies depending on, the objectives of the individual, what stage they're at. Sometimes, we come across clients that, are in a better position than they realize. And all they need is a bit of a kind of a pat on the back and to see that they just need to keep going.
Yeah.
Because having a lot of money in the bank isn't a sign, and I think you referred to this earlier, of success. A lot of the clients that I find tend to be probably more advanced in that kind of plan towards financial independence. They don't have much money at all. What they do, though, is that they're using the money effectively. They're putting money into pensions. They're putting money into savings. But their accounts don't sort of perceive an idea that they're very wealthy or anything.
Sorry, just that word wealth. When I hear you use that word wealth, I know I mentioned on our Zoom call together Naval Ravikant, who was one of the first guys I probably heard talk about wealth in this time concept, this idea of it's not the amount of money you have in the bank account. It's what does that money mean to you? Does it mean you have the time you want to do the things you want to do? Well, then you're a wealthy person because you're not handcuffed to the money. If your lifestyle, if you make €1 million a year, but your lifestyle costs you €1 million a year, that's not wealth. That's not freedom. There's no freedom there. Naval's that concept to me was really appealing, because it meant that, okay, well, we're not all going to be millionaires, but you just said there we could all have financial independence, and that's a completely different thing. It's not to do necessarily with the number, but your plan. And you also made a very interesting point there about people getting PCP and stuff on cars. And I've always thought this: if you need PCP or something, unless it's a strategic move which fits in with your plan, if you just want a nice car and you can't afford it right now, and you take out some sort of a loan, that doesn't necessarily mean you can afford that car, because if you don't have a plan, you don't know how that fits into your plan, that could cost you so much money in the long term. There's a lot of people who buy nice cars or big houses who are then completely under those assets for the rest of, they're not assets anymore, they're liabilities now for the rest of their life, because they wanted the nice thing. But that word afford, it doesn't necessarily mean that you can afford that thing right now. And that's where I think all of these different schemes that have come in, I don't mean scheme in a negative term here, but these systems that we can use, like PCP or loans, to buy these things that we couldn't if we just didn't have the cash in the bank, have potentially created pitfalls or traps for people as well.
I agree. And it is one that, personally speaking, you're correct in that these are loans and they must be recognized as such. And typically, we try and help our clients strive towards having just one loan, which is your mortgage. It's a loan that you have to carry. There's no way most people can afford to buy a house outright. So therefore, once they have that sort of positioned, what we do is we work on saying to them, okay, if you can get on the front foot where, okay, you may not be able to afford the car that you enjoy driving now, and that has to go into that financial plan that we spoke about, and it needs to be allowed for and worked on as a challenge to try and reduce the debt because of the cost of debt. We spoke about return of investment. When you get the next car, hopefully you'll be in a better position, having built up some savings, this kind of fighting fund, as I call it, where the next loan will be smaller. And again, the exercise continues. When you get to a point when you don't have any car loan, it might take 2 or 3 cars time to get to, but it needs to be worked on, because as you said, Dan, it's this kind of living in debt in the red, as I call it, that doesn't enable you to do the other things that I feel are important. So, I don't have an intrinsic massive issue about someone having a car loan. Why I have a problem with it is that that's a repayment. Let's say it's 500 quid a month that someone's paying for a car, and they can well afford to do that. It's stopping that 500 euros a month going into other things like the pension and like the savings. And I talk to them about how we can reduce the tax they pay, and basically get that financial independence earlier. I often come across clients that are doing quite well for themselves. They genuinely, like, they're earning decent money. We're based in Little Island in Cork, and we're surrounded by, big multinational businesses, typically quite well paid individuals. And yet, some of them are not struggling, but they're not applying themselves to the fact that they're saying, okay, I've got a good pension. And, you look at their pension contribution, their projection, and it looks reasonable. And by the age of 65, you'd say, okay, that should be enough for them to retire on. And I have very fixed ideas about what I think someone should try and achieve in their pension fund. And I'm very clear, and there's no sitting on the fence. I say to everybody that I meet, the ideal is you try and achieve a pension fund independent of the state pension of about 400,000 in today's money. That's the general rule of thumb. Okay. So, and I'm not going to, disperse from that. Some people achieve it quite early in their careers because they may have had an opportunity where their employer has been very, able to fund, and they've worked in one company for a long time. And some people, it may take a bit longer. And it's not that you have to get to that. It's just, sometimes people mostly don't realize, like, what I'm actually trying to aim for. Now, the reason why I say 400,000 is just, again, not getting into the weeds, as you call them, but if somebody has 400,000 at, say, 60 or 65 years of age, what that would give them is 100,000 tax-free, typically a quarter of that money. And the 30,000 that remains, they could draw an income of approximately 8% of that, which is 24,000 a year for their full lifetime. Now, you might say, Christ, 24,000 a year, that's not really going to give someone a really good lifestyle. But if you blend in the state pension that most of us be entitled to, you're getting close to the threshold, which is that 40,000. You'd hopefully have no loans, as we spoke about earlier, financial independence. Your children, if you have kids, hopefully will be at that age where they don't necessarily have to have finished college. I have some clients that have become financially independent and they have teenagers. And you say, hang on, how is that possible? Because they've funded for their future requirements. It's within that plan that we speak about. But the point being is that 40-odd thousand a year income with the 100,000 in the bank that they can draw down to supplement, the time in which before the state pension kicks in, let's say, I believe for most people that should sustain a reasonable lifestyle. You're not going to be living on desert islands, drinking tequilas all day, but it certainly gives you an ability to have, some lifestyle in retirement. Now, sorry, I got off the point a small bit, but those that are doing well, I say to them, do the best you can, because I often say to these people, look, can you afford to put more into your pension? Let's look at the plan. And if it allows for, and I talk about this compartmentalization, is there that ability to sort of take funds from one place and divert them to the other? And you say, well, Nick, what's the point? Like they're going to have a good pension scheme. But then I say to them, but would you like the idea of being able to, retire or take financial independence? I call it. It doesn't mean retiring. You could change job. You can work less hours, less stressful job, whatever it is. Would you like to get there sooner? And for most people, I say you should, because things can change. Like we talk about health. Sometimes ill health can happen. There's lifestyle changes. Typically some people take time out, career breaks. There's been people that, interestingly, recently I've come across, not just women, by the way, just men as well, that are looking for time off, just because of exhaustion and so on and so forth. So there's all this, and then there's the economy as well. So you've got difficulties where, like we've seen it in tech of late. I know you mentioned Facebook earlier, where people are being laid off, and then there's this uncertainty, and then there's this period of which maybe they're not going to have a pension because they have to go into a new job and they have to go through this probationary period where typically there's no contribution. So there's a lot of moving parts there. And again, it's just an understanding about, I spoke earlier about, soccer. You want to aim to like do the best you can. You get on the pitch and you put your best performance in. And I say that about finances as well.
Yeah, I like how you say soccer as well, because here football is GAA.
Yeah, okay.
I'm a big GAA fan. With pensions, to stay on that topic for a second, a pension is not a pension. There are obviously there's the state pension, but depending on who you work for, how it's set up, there are many different schemes when it comes to pensions. Aren't there? Is it important for people to really get a bit of an understanding around what their specific pension looks like if they're involved in a company, because this will severely or significantly affect their plan, I suppose, won't it?
I think this industry, the financial service industry, as much as I love it, is fraught with complication. It is so, like convoluted. It's ridiculous. There's so many different names of pensions. You get bored to tears. And whenever we use the word pensions, people just switch off, So what I say to them is, okay, really the most important thing for most of the listeners is, do you have a rough sense of what your pension, there I use that word, is worth as of now? And you might say, no, I don't have a notion. I say, well, but respectfully, like that could be a fairly sizable asset. It could be worth 20,000, could be worth 50,000. Would you be as loose to sort of think that, like that's not relevant? Because as part of this financial plan, it surely has to be. I spoke earlier about compound interest. Can you imagine 20,000 increasing in value every year for the next 15, 20 plus years? That could be worth 5 times that.
Yeah.
So we just say to people, look, again, without too much heavy lifting, typically that's what you'd expect from a financial planner, is get a sense of what you have at the moment. So like, do you have a pension from a previous employment? We touched earlier, Dan, about UK pensions. I obviously worked in the UK for a while, and we've reached out to people saying there's an opportunity for people until the 31st of July, 2023, for anyone who's listened to this recording before then, that they can buy up to 17 UK state pension years. After the 31st of July, 2023, you can only go back to buying 6 state years. So we're saying to people, and this was one of the interesting videos that we did on TikTok that went viral, because it was the right message and it was delivered in the right way. And it was something that people were really, really interested in, because it's like, it's money for jam, and I don't often say that in this industry, but certainly for me, and I'm one that went through the process. I've applied to buy back those 17 years. I left the UK, as I said, back in 1999. So the benefit to me is much greater than the cost. The other thing is, you mentioned pensions. All I'd say to everyone is, it doesn't really specifically matter about you knowing exactly what your pension is or what it means. It's about knowing what it's worth to you now and how can you affect it between now and that age of financial independence. So I mentioned I'm 49, I'm going to be 50 later this year. I have 10 years of what I perceive to be kind of the hard slog years, where I'm trying to grow a business and I'm looking to, achieve objectives. I have 4 children in a blended family ranging from 18 down to 8 with different, financial objectives. I've 2 children in fee-paying secondary school, don't mind third level. And they came at times where, I wasn't aligned to, and I've had to sort of cope with those. So I can talk from experience about helping people, plan effectively. But in terms of, the pension option, what I'm saying to them is that all you really need to do is know what can you do from here on in to improve your situation. So you understand where you are today. So Nick, if he has a pension scheme worth 100,000, 50,000, whatever the figure looks like, what can I do between now and that 60th birthday to get that figure as high as possible? One is by contribution, and the other is by the performance of where that fund is invested. And I ask people, I say to them, look, you have a company pension scheme, for example, if they're an employee of a company like Pepsi or Eli Lilly or whoever they are, and you're contributing 5%. And they're saying, yeah, that's the maximum I can do. And I say, but respectfully, that's not the maximum. It's the rate of which they will stop paying. But based on age-related limits, which vary from 15% of your salary up to as much as 40%, you can do a lot more. And they say, well, okay, but why should I do that? And you say, well, for every 100 euros you put into that fund, let's call it a savings fund, you will get 40 euros back from the tax man if you earn over 40,000 a year. And they say, okay, so it costs 60 euros per 100 euros that goes in. And then I reframe this. I keep talking about reframing. So again, if I said to you, if you gave me 60 euros today to put it into a fund for the future, and these pensions can be accessed from age 50 onwards, by the way, and it turns into 100 euros, that's a 66% gain. So it's not a 40% reduction, it's a 66% gain to you. So that has to make sense.
Yeah.
And then interestingly, and again, unfortunately, the financial services industry is fraught with people that unfortunately are kind of biased by commissions. And they talk about, transferring pensions from different jurisdictions like the UK, which I'm definitely not a big fan of. And again, I can explain in more detail why. But the fact is that if you have separate pension schemes, and we've all changed jobs at one stage or another, or we're probably likely to, and that's just the way of, I suppose, the world now, you can transition. There's been a lot of studies, and again, Dan, you might have looked into this yourself, where rather than people working up until a day and then this hard stop, there's what they call this kind of phase transition, because for mental health reasons, it doesn't necessarily suit people. So what's happening is now we're saying to them, look, you have different pension funds, say, built up from, you might have worked in a job and left that job, and then you're now, working for yourself. So you're typically going to have at least 2 pension schemes. And then you can draw them down at different times to suit your financial requirements. And if you're under financial hardship, you might look to access one of those pensions from the age of 50. So it's useful to know that there are options, and we try and present those options to people and explain to them, the pros and cons of those decisions.
Yeah. I'd like to remind people listening, because as you're speaking there, part of me is like getting freaked out by the amount of information that there can be there, but this is what you do. This is how you help people. So it's kind of a similar thing with, I talk about with health as well. You don't necessarily have to go and become an expert on pensions or tax or any of this kind of stuff. You do have to know that there are options out there, and you do have to be willing to spend a little bit of time and find the right people and have discussions about this stuff, and potentially speak to Alpha Wealth or somebody who can actually help you. But this is a massively positive thing, because I was like, oh my God, there's a lot of different things to think about here. But I don't necessarily have to be the expert in pensions. But again, coming back to having that plan puts me in such a position of power, because I can have people to advise me, but then I can know that every decision I make is in line or not in line with the ultimate goal, which could be the 400,000 or a bigger pension or whatever it might be, the lifestyle that I want, the financial freedom, which is really, really empowering. And having people like you out there who do that almost seems like a bit of a cheat code, really, because you think you just have to trust these particular financial institutions, and they'll just, this is again to bring us back to the point, this is just how we did it, this is how it's done. But yeah, the pension thing is one that really I can almost feel my own eyes glaze over when people start talking about pensions. But having you explain it in that way, it really kind of brings it home, because we're all going to get there. Well, hopefully, we're all going to get there at that point, and then the regret would be just not having put a little bit more time and energy in, because it's not about going out now and earning a load more money because you want to have the money then. It's just about having that little bit of a plan, that little bit of a strategy.
Absolutely, Dan. And as I say, look, without trying to sound like a cliche, a lot of people refer it to like going to the doctor. You know, you might have a sense of what's wrong with you. And obviously with the advent of Google and so on, you know, it's interesting. My wife, she's from a kind of a medical services background. She worked in pharma for a number of years, you know, and she often kind of Googles and sort of tries to look for solutions. And I say to her, look, it's best to go to the experts. And it's like that with financial planning. It's a case of, you know, you don't need to know the nuances and exact intricacies of income protection or, you know, mortgage protection or a pension. It's more about just having the confidence and a faith in someone that you can say, okay, they know what they're talking about, and that they can steer me in the right direction. And again, there's some really good financial planners out there. You know, I spoke about, you know, our business, and the fact is that the key thing is, in my opinion, is to make sure that you find someone who's independent, and that fees are a big part of the industry as well. It's unfortunate, but what I have found of late is that, you know, again, sometimes we come across clients that they have the right vehicles, as in they have a savings plan and it's geared for what they need. So again, I mentioned earlier that if you have a financial objective that is 3 years from now or beyond that time, so say, for example, some of the listeners are looking to, say, build up a deposit for a property, saving it into a post office, credit union, or bank, if they have more than 3 years to go, I believe is not really suitable. Why? Because we're going to suffer inflation for those 3 years, which will be a minimum of 3%. That's the ECB's kind of long-term goal. It's higher at the moment, obviously. And you're not going to earn much at all from the banks. So there are alternatives out there, and generally speaking, they're with the insurance companies. And we come across people that have these products, but the fees they're paying, unfortunately, they're not going to ever make anything. The only people that will benefit are the financial advisor and the insurance company that provided the product. So it sometimes gets down to the kind of the nitty gritty of saying, okay, well, you have the plan, but what is the plan actually costing you? And then you're looking at sort of, and I the way I describe it is like, it's like comparing apples with apples. And we often sort of say to someone, look, okay, so you've taken out mortgage protection and you're paying 40 euros a month. And here is exactly the same plan, but it costs 30. And what happens in that instance is that the financial advisor gets remunerated because it's a new product, but the client saves 10 euros a month. So it's kind of like a win-win. And that's where I see value for both the advisor and for the client, because obviously, you know, you want to make sure that your interests are aligned and that, you know, it's the right thing for you. Now, that's not always the case. And again, I would prefer for people to stay with what they have. There's less hassle. But in a lot of instances, unfortunately, we find that people haven't necessarily kind of brokered the business, as I call it, which is that you discount it, you use the cheapest providers. And, you know, unfortunately, some people don't realize. So just to touch on health insurance, and again, not to jump off topic, but, you know, again, there's 3 different companies in the marketplace, as you might be familiar. There's Leia, VHI, and Irish Life Health. And as a product, again, that we don't provide, but we're quite expert in, and I have health insurance myself, I've only ever paid for one child. Now, the significance of that for me is enormous because, again, we talk about, you know, trying to do the right thing, which a lot of people do strive to do. You know, they want to make sure that, you know, their children get into, you know, a private hospital if something happens to them. And that's typically the reason why most of us have health insurance. But you can get, you know, offers through some of the insurance companies, and people just don't realize. So that one small point can save you. Typically, the cost of a child's health insurance plan is about 300 euros a year. Again, I have 4 children in a blended family. Like, you can see the significance. That's about 1,000 quid a year. Yeah. And that's not to kind of scrimp. It's not to go for inferior plans. Some of these plans are actually better than the plans that most people have. But it's about understanding. Again, like that, I pay for my health insurance online. I'm with Leia personally, and the plan I have suits my requirements. So it's about making sure it's fit for purpose. So I get a 10% discount on my plan. But every year, believe it or not, I have to cancel it and rebuy it. Why? Because as an existing customer, Leia won't provide me the benefit.
Discounts, yeah.
But it takes me 2 minutes and it saves me €100. My plan costs me about 900 versus €1,000 that it should cost. It's a no-brainer. For me, it doesn't matter what I'm doing that day. It's the best use of those 2 minutes. And sometimes people just need a little bit of a steer to understand what they're doing. Again, unfortunately for people, and we talked about financial literacy earlier, the market, so the health insurance market is so convoluted. There's over 500 plans available.
500?
Yeah, it's incredible. And there's new plans being introduced by the week. And the HIA, which is an independent body, have a website. It's a really good website. And I've seen it advertised actually on the television recently. But they expect people to be able to kind of navigate it. And it takes time, experience, and knowledge of what it is that you actually require. So I mentioned earlier about, inpatient care, which is why does Nick have health insurance? I have health insurance because I want to know that if I am sick and I have to go into hospital overnight, that I can get access to a private hospital. That's the main reason. It's semi-private room rate. I'm not going to be in a private room. Those types of plans cost a hell of a lot of money, and it just doesn't suit my affordability. But things like outpatients then, which is the other main reason, which is things like claiming back for GP, physio, and so on. And again, a lot of people who work in these kind of multinational type companies, they tend to have plans that have very good benefits there. But they don't claim for them. So I say to them, okay, one of the simplest ways I can save you money is we just make sure that you claim back for these things, because we're all too busy and sometimes we forget. Now, I personally feel like most men that I'm like Superman and I won't claim for those things. So I don't avail of that in the policy that I have. So I have a good inpatient plan, but a very bad outpatient one. And it suits my specific requirements.
Okay.
I don't really play sort of team sports anymore. So the probability of me getting injured and going to a physio are much less. I tend not to see the doctor. So again, it just suits my situation. Whereas with some individuals where, let's say, they do play sports and they do tend to pick up injuries and they do require the use of a physio, there are certain plans that will be more suited to their purposes. And we just help them sort of navigate that and find the right plans. So it's a really big area, and it sounds small, but the amount of money that you can save in that one market alone is enormous. It really is. And all I'd say to anyone is, if you're under the age of 34, you need to think about whether it's worth actually spending the money, because only from the age of 34 onwards is there a levy, whereas if you don't take out health insurance, that you will be charged when you do come into the market. So that was just one, I suppose, nuance to the industry that they brought in about 6-7 years ago. So no, I'm not saying that anyone under 34 shouldn't have health insurance. All I'm saying to you is you just need to balance that between your other objectives. And if you're relatively fit and healthy, is it worthwhile spending €1,000 a year, roughly, which is the general cost of a decent plan? No, I personally don't think so. I think you'd be better off, again, spending that money in certain things like savings for your, requirements, maybe buying a house, or indeed starting to sort of front load your pension for the times when things can change. I think you touched on earlier, Dan, about, you make hay. I'm a great believer of that. You make the hay while you can now, while the sun is shining, because we've known and seen like there can be storm clouds coming very, very quickly.
Yeah. And they can be very unexpected as well.
Absolutely, yeah.
Yeah, and it's really, really interesting, based on everything you've said so far, and having a plan and empowering yourself and having a strategy, that extra €1,000 or a couple of €100 here and there, while it may not seem like a lot, especially if someone's earning a decent wage, the thoughts of having to go, because like we do with electricity and stuff like that as well, like new sign-up plans, you get bonuses and €150 off, and you're like, the effort of having to deal with these people on the phone who know what you're trying to do and they're trying to slow you down. But that money isn't just that money. It's the potential to, as you said, invest in your future as well. So all of a sudden, it's more leverage that you have, which could potentially, in the long term, when you do hit that retirement age or financial freedom age, it's this idea, look after the pennies and the pounds, look after themselves. Like having all those small little bits working for you could have a massive, massive impact.
Absolutely. And it's interesting because, again, people often say to me, Nick, what's your USP? And, again, this is not me trying to plug Alpha Wealth. I just think it's very important to note that the reason why we get involved in mortgages and the reason we get involved in health insurance and the reason why we get involved in car insurance, which again is not a product that we sell, is that I want to be able to say to somebody, if I am in front of them, say, well, okay, this is an expense that you're suffering. How can we help you get that cost down?
Yeah.
Or is that the best spend, cost that you can get for that particular product. And it's an off-the-shelf product. It's not that there's a massive variation of car insurance policies. You just pay for it because you know you need to. So therefore, we just give them access to a couple of brokers that we deal with. We don't get paid by them. And we just help them verify, are they on the best deal they can? I use a company in Cork called O'Leary's. I've no problems mentioning their name. And all we do is we provide the contact that we deal with. And we find them to be very, very good. And all we do is we just check in and say, is it giving you that independent kind of verification of, because again, like that, with great respect, some people say to me, Nick, oh yeah, no, every year I kind of shop around and I ring around a few places. And I'm like, great, I'm delighted you do that. And without meaning to sound any bit sarcastic, would you not consider maybe just, checking in, and if you're not using that provider, just make sure that you're getting the best deal? Because I think it's really important. And you mentioned earlier, Dan, about, look after pennies. It's more than just pennies. Like, these things are typically, a lot per year. And it's about then applying it elsewhere. We spoke earlier about, people who, tend to spend what they earn. And I mentioned that, unfortunately, it's just a part of kind of human nature that as we earn more, we spend more. We tend to go on a slightly better holiday. We tend to go out a bit more maybe than we used to when we weren't earning as much. And if you can try and apply, these increases in salary and these bonus payments, particularly like, for example, pensions, okay? And it's not that I'm a great believer of pensions. I just think it's an area that people underutilize because they don't fully understand them. But for anyone who's in a position where they get a bonus at work, and let's say it's 5,000 euros for argument's sake, we spoke that, obviously 52% of that will be taken if you get it as a physical payment to yourself. Okay, so you get about 2,400. If you can afford to do without the 2,400, you can put all of the 5,000 into your pension. And we spoke earlier about, how you can you get growth on that, tax-free, and it accumulates up until 50 years of age, as we said. Like, that to me is a really, really useful way of, getting to that, as we called it, financial freedom. Yeah. It's not about me trying to sort of find this kind of rabbit in the hat. There is no kind of free lunch. Let's call a spade a spade. It's about just making the best of the situation we find ourselves.
Yeah, little nuggets like that, they're so powerful. Look, it's life-changing information for people. And again, it comes back to this initial thing we spoke about many people who will listen to this are making a good living, but are still struggling. And these are the small little changes that could just transform that. All of a sudden, you're in control. You're leveraging that, like 2,400 euro to 5 grand into your pension. Like, that's a massive difference.
Absolutely.
And most people just aren't aware of it. Not to go into something that's too big and meaty, but taxes, tax planning. When people hear tax planning, they're like, well, the tax is what revenue taken, the government take. Well, am I going to plan for tax? They're going to take their money. But tax planning is and again, that only came into my purview when I started to run a business. I'm like, okay, there's some decisions you can make here that are smarter decisions than just earn the money and pay yourself the money. What should people look for? Some of the kind of the bigger picture areas when it comes to tax planning, the average person with their taxes.
So for people who have a job, as in work for somebody else. So, I refer to them as PRE individuals, but, those that just are employed by somebody, they don't have as much ability as business owners. So I would segregate them. Yeah. So I'm just going to focus on the PRE workers initially. So typically, pensions are one of the biggest areas. So again, that's why we tend to focus on that for those individuals. The thing about it is that it costs you money. I gave the example earlier about giving up the 2,400 for the 5,000 benefit. You're not going to be better off. You will longer term, but it's a sacrifice, and it's about making that sacrifice. There are other ways in which you can reduce the tax you pay. There's one other vehicle now, not to get into too much of that today, but again, if someone has money personally, there is a tax scheme in Ireland. It's available. It's approved by the government, called the Employment Investment Incentive Scheme. And it's a takeaway for anyone who's on the high rate of tax that if you make an investment into a qualifying company, there's about 50 or so each year that look for this type of finance, the Irish government will give you back 40% of your contribution to that company. It's a 5-year scheme, and there is risk. Obviously, again, we talk about this no free lunch approach where I explain to people what are the companies that are looking for this type of finance. And they vary. There's some very good ones and there's some not so good ones. And typically the scheme is devised, and it was set up in 2011 to help businesses grow. So Dan's business, Nick's business, if we look for finance, it's a way and a mechanism for us to get that money where it will end up costing us less than perhaps getting a bank loan. And sometimes banks won't necessarily support a particular business. But the investor, the person that is putting the money in, gets that rebate from government, and then you expect a return of investment from that company. And you effectively get an agreement where you become a shareholder in the event of the company not paying you back. Now, obviously, we can see that there's risk immediately because what if the company fails?
Yeah.
So what is our role in this is to educate people. And we spoke about, giving people that financial information. So we show them companies and we show them why we believe that these companies are best poised, why they should survive and how they've grown over the last few years. And you look at their balance sheet and you understand them. I know it sounds very left field, but there are companies like whiskey companies that look for this finance that have traded very well. Now, some of the listeners listening to this might say, hang on a second now, there's no way I'm going to invest in a whiskey company. It's not about necessarily investing in the company as in, okay, yes, it's important to know what the company does. It's about the individuals involved. It's about their balance sheets, about their prospects, and it's understanding the concept. But our job is to obviously educate people to say, yes, this is an opportunity to reduce the tax you pay. Now, like I was saying earlier about pensions, you have to have money to do it. The biggest way that we help people save money on tax is by having money to deal with the problem. And that's where this kind of like, it's almost like this vicious circle.
Yeah.
People pay too much in tax. They don't have enough money. They pay too much of that. If you can break the cycle and have a bit of excess cash, then you can apply it and get this rebate back from revenue. And if you keep that conundrum going, a lot of people we work with have shares in the company. So they accumulate shares. Sometimes they're provided to them for free, and sometimes they can get kind of excess shares by buying into these schemes. And they're generally good. They buy them at a discount, and I would normally recommend that people do them. But on the same breath, I would say sell the shares also, because we're coming across people more and more where they're working for companies like Pfizer and Lilly and so on, and they're accumulating like tens of thousands of euros, mostly kind of unawares of the fact. And again, it's very easy for a financial advisor coming in from the cold and saying, looking at your overall portfolio, Dan, you've got 20,000 in Pfizer shares and you've got no other investments. Like, that is not diversification in any shape or form. Now, again, then they start to become speculators in the share price and looking at it. And I say to them, look, you've got to take that off the table. There is no ability for you to understand which way that share price will move. And then it's this risk reward that we speak about. And all I say to them is that you are missing opportunities by not selling the shares. Number one, because there is an annual tax allowance that you should look to avail of. And the second reason is, even if you want to hold shares, buy them in a different company, sell some Pfizer shares and buy Apple. Why? Because at least you've got two different shares in two different industries, and that starts the process of diversification. Now, I'm not convinced that that's necessarily the best approach, but you get the point.
Yes.
And as I said, so it's sometimes it's subtle approaches. And then I mentioned earlier about this EAS scheme, this tax scheme, selling those shares, getting the benefit of those, and then applying them to a scheme where you get a further benefit. That's what I call like this kind of win-win, and that to me then is a great way of people not necessarily reducing the risks that they have. It's more about then diversifying, but always looking at the tax consideration, because that is a much better way. The other one then, just for the POI individuals, is using the revenue online system. And again, that's something that we can help people with. We're more than happy to share information, obviously. And again, there's no cost to any of the listeners if they want to reach out to us. But making sure that you're claiming for things like anyone who stayed at home for the last 4 years can apply for a credit for that. Anyone who's renting, apply for your €1,000. Really simple things, but they can get back quite a lot of money. And the fact you can go back 4 years, to me is monumentous. The other thing is for company owners, and again, I won't delve too much deeply into this. A lot of people who have set up companies, so myself, yourself, Dan, a lot of people who are working for companies, but they've contracted to them and set up a limited company, sometimes fall foul of the trap that because they were earning like 50, 60, 100,000 a year before they started their own company, they try and mimic that. And to me, one of the major advantages of setting up a company is you are now in a position to manipulate the salary that you pay yourself. And all I say to those individuals is, if you were drawing down a salary of, say, 60,000 a year, because that's what you were being paid beforehand, can you afford to live on 50,000? And again, we talk about that 52% rate. So, can you afford to be without the 4,800? And in some cases, people say yes. And I say to them, okay, well, leave the money in the company, and then you can look to get it out tax effectively. And that's the kind of the analysis that we help them with, and say to them, okay, but you say, well, what can I do if it's in my company? Well, you can build that money up and then effectively withdraw it, tax-free in the future. You can look to apply that to a pension scheme, and you've got much greater scope to do so. So there's loads of mechanisms. You can employ your spouse, your friend, your partner, your kids. You can pay into pensions for them without them drawing much of a salary. There's huge opportunities, and the landscape has changed. There was a big monumentous change in January of 2023, which was that revenue, and it's a really, really interesting one, because very rarely do revenue do things to the benefit of individuals. But for any senior managers that are listening today, or any business owners, one of the most important things that's happened is effectively there is now unlimited scope for a pension contribution to go in to a company, from your company, on your behalf. So if you're a senior manager and you're being paid 100 grand a year, and you have the ability to get your company to pay a bonus directly into your pension, or even forego some of that salary, so you can reduce your salary to 80 and apply the 20 grand. There's no limits to that. Interestingly, the largest pension scheme that anyone in Ireland should look to achieve is a figure of 2.15 million. Now, that figure may seem enormous to some individuals. And some of those people who have, long-standing employments with some of the bigger multinationals, believe it or not, will generally tend to achieve that before the age of 60. The equivalent figure in the UK is 1.07 million. So really interestingly, that in Ireland, there's one big positive for us, which is that we can benefit from a much bigger pension pot than our UK counterparts. And we tend to follow the UK very, very much.
Yeah.
So the significance of that is to say, well, okay, Nick, you mentioned earlier that 400,000 is a decent pension pot. And it is. But for some people, particularly if you've got, someone else that you need to pay for in retirement, maybe they weren't working, or indeed you want to have an even better lifestyle, that's the starting point. Like, it's about getting north of, whatever you can try and achieve. But the key point is, what I'm saying is, if is a business owner that has a lot of cash in their company, and without getting carried away, we've seen some instances over the last few months since the 1st of January, where let's say a business owner was drawing 50,000 a year and had excess cash of 500,000. From the 1st of January, the ability now is for that business owner to put that full 500,000 into their pension fund.
Wow.
Without any questions. Or indeed, if you were really taking this to the next level, they bring on their spouse or partner, pay them a salary of 100 quid a year, and pay 100,000 to their pension. And then they bring in their 16-year-old plus child, pay them 100 euros a year, and pay one into their pension scheme. But the scope is kind of endless, really, within those 2.15 million limits. So for cash-rich companies, and again, I'm not suggesting that there's hundreds of companies out there with,
half a million
in the bank. But there are some that are aiming to get there.
Yeah.
And again, it's more about understanding the opportunity, because what's happened previously is, for most business owners, you were limited by the salary that you were drawing and the number of years that you set up the business. So if Dan just set up a company yesterday, you're going to be very restricted in the first few years as to what you can put into the pension. That has now changed.
Okay.
That's completely gone to a side. We are helping clients as well buy properties in their pension. So I come across a lot of people who have investment properties, and people say to me, Nick, okay, I have this investment property. What should I do? And I say to them, you should look to put yourself in a position to sell it. A little bit controversial. Some people don't agree with that, but I feel very strongly, and I explain why. I say to them that typically for most of those individuals who tend to be high rate taxpayers, they're being taxed typically at 52% of the rent. There is risk with holding an investment property, and that's why a lot of landlords are leaving the market. Okay. Now, I'm not telling them to sell it. I'm saying to them, put yourself in a position to. So what does that mean? I say to them, look, have you offered the property to the tenants that are there? Because if they'll buy it, it saves you a bit of hassle and time. If they're not in a financial position to, my suggestion would be that you put the property, give them notice, and make sure that you follow the relevant RTB guidelines. It's very simple, but it's important to make sure you do that. And you said, Nick, why? Well, you're going to have to give them typically 6 to 9 months notice. And we spoke earlier about, being flexible and rigid, not rigid, but being able to adapt. So if you don't do that now, if the environment changes further, let's say interest rates continue to rise, you can't do anything because you're back onto this 6 to 9 month period. And all I'm saying is everything has a price. So if you said, oh, Nick, I have that investment property, it's in Dublin or it's in wherever it is in the world, and it's worth X. I'd say, well, okay, if you would sell it for Y, then test the market out. And if you get Y, sell it. And if you don't, then just relet it. And it's a very subtle kind of point to make, but I feel very strongly that we're back to the whole point about helping people to understand and manage their finances, and this is where coming in from the cold, it can be easier. But now I'm not against property. My father built up a lot of property in the UK. And again, we talk more about tax planning and estate planning and helping clients, understand about trying to mitigate the tax even their children will pay, which is a whole topic in itself. Again, one of the takeaways today is that if you have children, even one child or more, one of the points I would make to you is that rather than you trying to benefit them in the future, which we all kind of aspire to as parents, really, we want to leave a bit of a legacy, I suppose. We want to help them on the property ladder. Obviously we want to pay for their third level education needs. To a degree, I should add, I'm not one of these advocates that you need like 40,000 per child that some of these commentators would say. Personally speaking, I never had that. And I ended up in college, I had to work part-time. And I think sometimes that might be a useful lesson for children in its own right. But notwithstanding that, doing these things, and we help people plan, and I talk about this kind of financial modeling that we do for clients, and it's very, very simple. But that if you can start to gift your children monies, and there's an allowance for each person in Ireland to give up to 3,000 a year to another individual where it doesn't eat into their tax threshold. And what I mean by that is that currently any adult in Ireland can give their children during their lifetime or on their passing a figure of 335,000. So imagine if, let's say, Dan has one child, and in the future, and again, it could be in, please God, 50 years from now, you leave your private home to that child. They're going to suffer tax on that if the value of the property is over 335. And by the way, that figure is not indexed. It hasn't gone up for the last 10 years. And if anything, it probably will come down because it's a tax that it costs revenue.
They did try to drop it, didn't they, in the last budget?
That's right,
proposed.
They were proposed. So all I'd say is, what's the relevance of that? And this comes back to planning. The relevance of that is that by you trying to build up money to give to your child in 20 years from now or 15 years from now to help them out on the property ladder, let's say, you start putting money into an account. They don't physically have to even know about it, where it earns interest, and we talk about the compounding effect, obviously, earlier, but that when that money becomes theirs, of a legal age, it doesn't fall under that 335 threshold.
Okay.
It's a really powerful vehicle. It doesn't require an accountant. It's a really simple mechanism. And we're coming across more and more people that they have the ability to do it. Like they're saving for their kids, but they're saving it in their own names because they don't realize that the opportunity exists.
Yeah.
So again, these are all kind of, I suppose, takeaways, but it's about an understanding about what you're trying to do and the best mechanism to use and the best way to form that. And what I would say to everyone is the biggest probably drawback, and we were talking earlier about kind of, why people do things in psychology, is a perceived hassle. We come across clients and they feel it's like a really big kind of hassle. And we say to them, it doesn't really need to be. Like we find that the industry has become a lot more efficient now. We offer consultations on Zoom. We do it in person. In Cork and Dublin, primarily, that's kind of the two locations we tend to focus around. But again, within reason, we will travel. But the reality is a lot of things are done now on DocuSign. There's no kind of formal kind of like, pages and reams of things that people need to have to go through. And more importantly is that we do the heavy lifting. I say to anyone that, this financial plan that we keep referring to, we ask people to do one thing, which is sign what's called a letter of authority. It's an authorization, and it allows us to reach out to the various companies and get details of any existing plans. And we put it on a spreadsheet and we then present it back to that person. Now, again, there's no cost to the individual of the process. They don't have to, do anything. There's no compulsion. But it's really important because there's no point me trying to help someone and we're not knowing kind of
where
half of
you
the
are
information.
right now.
Where you are right now, So I know I come across people and they say, oh, yeah, I have something with Irish Life, or maybe it's Aviva. And look, I understand. Look, I get it. I've been through the process many times where, they don't realize but it's significant to kind of understand what it is you're paying for, and then it becomes relevant to the overall plan. And all I'm saying is they don't have to do anything. They literally just have to sign the authorization. Let us go off and get the information for them, and whether or not they act upon the advice is a different thing. We say to people, you should never feel under this kind of massive compliment to do anything. It's more about just knowing how best to sort of deal with the shark infested waters, I suppose, of life as it happens.
Yeah, and when people get that information, then they realize the opportunity that lies on the table. It's a very powerful indicator there. Just to wrap up the tax piece, because I know there's a question burning in people's heads who don't really understand maybe tax. This idea of avoiding paying tax to a lot of people seems, that's a bit dodgy. That's illegal. That must be illegal. People, and I know a lot of people who don't run businesses look at people who do run businesses and say, well, sure, you could just, you get a tax break on that. Or you don't have to pay for that because it's tax free. There's all these different misconceptions around tax. I think what you've explained there, it's not about not contributing to the greater good, because you all understand the concept of tax, but it is about understanding that there are ways that you can maximize the money that you're earning, because people aren't paying 52% tax on the money that they earn. It's a very difficult psychological concept for people to come across, because you tell me I'm earning €100,000, but actually 52% of the extra 60 grand or whatever is not so it's not about not paying what's due, but it's about understanding where that line is for you. You don't necessarily have to pay all of this extra tax, because it's extra on top of what you should pay to contribute to the greater good. Would that be fair to say?
Absolutely. And again, I'm a great believer, and people often say to me, Nick, oh yeah, I have some shares and I sold them and I never told the tax man. And, we would always obviously encourage people to say, look, you're best off to be upfront and to face the problem, and sometimes that comes down to, obviously, again, the stress that some people suffer. And it might have just been through ignorance. They didn't realize, and we help them understand. And whilst we're not tax advisors and we can put people in touch with them, we have, again, no bias, but we have access to having dealt with different advisors over years and different people and have different specialties. But a lot of people who work in companies who they sell the shares that they have received from the companies, they don't have a notion as to how to even deal with the problem. Yeah. Now, we can do that at that level. That's fairly straightforward. But simple ideas, again, for any business owner, if you've set up a business and let's say, you have a partner who's not working, you can employ them as long as they have some form of duties. And again, that's a very loose kind of phrase for a lot of business owners. But you can pay them up to typically $30,000 a year at the standard rate of tax. So that's an advantage for people, because there's no point, Dan earning 100 grand a year, paying 52% on, as you said, the 60,000, when Dan can draw 70,000 a year, hopefully a bit less than that, as we spoke earlier, and pay someone else 30,000 if it's appropriate for that situation. And again, you can bring kids from the age of 14 into the equation, and it's completely legitimate. We're not saying that there's anything untoward with this. We're great believers of saying, look, you've got to face these head on. And we've come across clients who, we've encouraged to deal with problems as well. And the most important thing is that, again, revenue we find to be very, very easy to deal with. I know people might maybe have a misconception or certainly an opinion. Believe it or not, we've rang revenue on behalf of clients many times, and they want to work with people. They really do. They're actually, we find them certainly of late to be a lot more kind of, I suppose, approachable in explaining about, difference for tax credits. There's some really good online tools, I keep saying, but EY have a really good tax calculator. We can send it on to anyone who's interested, but it's a really, really powerful way of just checking a pay slip and seeing that you're paying the right amount of tax. And you'll be amazed by how many people are not paying the right amount, typically overpaying tax because they just they're on the wrong tax credit, or they haven't told revenue that they may have got married, or that there's a single person's carer's allowance and so on and so forth. And it's really just important just to kind of do that quick check. And again, we typically do that for our clients in the first outset.
Yeah, it was probably some of the most ardent advice I ever received when I was working on this business from various different advisors. Is have a general understanding of how tax works, work with revenue, keep everything above board, because there's always a temptation for people to run their own business, whether they know or don't know. There's a bit of cash here, and
Absolutely.
it was the best advice I ever got, because once you understand it, because I didn't understand it, terrified me, to be honest with you. I'm still not, as I mentioned to you before, particularly financially literate, but I'm learning, and through learning about tax, it's made me feel a lot more comfortable with the process and understand that it's not the big bad revenue knocking on the door, that I actually have a lot of control here, and it's the best option is to meet it, as you said, face on, and to understand it, and to plan for it, and have a strategy around it. And it's just a much more comfortable position to be in. No one likes paying tax, but if you want to operate and pay tax, there's a right way to do it and a wrong way to do it.
Absolutely, yeah, absolutely.
Yeah. I'm gonna wind us up now slowly. That could mean we could be here for another hour. But I'm gonna wind us up now slowly. There's a couple of things I'm really interested in. First of all, you obviously have a background in the UK and an extensive history here in Ireland. Now, one thing I have definitely noticed is very common here is our relationship with money is very weird. There's a weirdness. There's a hesitancy to talk about money. There's a discomfort around dealing with money. There's a fear of money. Have you experienced that here? Is question number one. And does that differ in places like the UK or further afield in your experience?
Definitely. And it's really interesting because having worked in the UK, albeit that I was working in investment banking in the UK, but I have friends who are financial advisors over there. It's a different market insofar as it tends to be kind of a lot more transactional. Okay. People are not really afraid about the finances. And it's probably, tends to be the fact that obviously it's a very big population size. It's less colloquial. Dublin would be the closest, I suppose, comparative. But even within that, there's still this kind of, somebody, and it's just 6 degrees of separation type, and that's where in the UK, it tends to be much less. So, we found that when in the UK, people are much more open about just talking about finances, and they tend to act probably a little bit quicker. I think, again, without making this sound like a generalization, my wife is Irish, so I feel I can say this. In Ireland, we tend to not want people to sort of know our business, and we tend to not want to tell people. And there's always this kind of perception that it's almost like, we want to better our neighbor. It just tends to be that sort of mentality. So we drive the nice car, even if we can't afford it type thing. But so really what I felt has happened of late, and to some degree, I think social media has probably helped this. People are starting to become a little bit more financially literate. There is probably a gap there. There's more probably in the television. I mentioned earlier about someone I used to work with. His name's Owen McGee, who talks maybe in more kind of reasonable language about some of the I suppose challenges that face people in their everyday lives. And I think hopefully people will sort of do more of that, because the more we're able to kind of talk about where we are and what we're trying to do, I think it only helps them. And I think the biggest problem a lot of people have, particularly when they're dealing with debt, is that they kind of keep it to themselves. It's the hardest thing. And you talk about kind of mental health. I've seen instances where people they almost get this kind of light bulb moment when they can see that there is an opportunity to do something. I was talking to someone who was really looking to buy a house there recently. And he had a credit history. Unfortunately, it was kind of a negative credit history over a credit card. And interestingly, he was able to get a mortgage with one particular institution, and he wasn't aware of that. And it really kind of it was kind of almost like life-changing for him. And again, these are just sort of instances where just by tackling something head on, and just even reaching out, it was really, really enlightening to sort of see how they can do that. The biggest, I suppose, issue with our industry is that we tend to sell what's called intangible products.
Yes.
You're kind of selling a lifestyle. And although you can sort of paint pictures of, this kind of fancy retirement income, people generally don't see that. Like a lot of people I talk to, if they're in their 20s and 30s, they don't really It's not that they just don't understand pensions. They just don't have any graph of pensions because it's so far away.
Yeah.
And unfortunately, the thing is, if they could deal with it early on, it's less painful to get to the same point. One of the biggest things, I suppose, just in case it's not brought up later, is I've spoken about compartmentalization. I've spoken about, being able to try and segregate your short, medium, and long-term objectives. One of the biggest things that we help our clients understand is kind of risk and reward. Now, okay, that's typically around the subject of investing, but it also encompasses pensions, and it also deals with short-term, more speculative investments. And, off air, we spoke briefly about cryptocurrencies, which was really hot topic about a year ago, and tends to fluctuate depending on how much the press push it, and depending on whether it's obviously on the climb or on the decline. But the risk-reward piece is really, really significant. And it's the one thing, I suppose, for all listeners just to understand is that the general rule and the biggest takeaway I can give you today is that the longer you put money away for, the more risk you should be prepared to accept. So what I'm saying there is that let's say you're in your 30s, and let's say you have a financial plan to become independent at 55 or 60 years of age. That affords you 20 plus years. You should therefore be in a position to be able to go quite high up that risk ladder. The scale tends to work on a scale of 1 to 7, 1 being cash, 7 being very high risk. And that would typically be in that the area of 5 to 6. However, if your criteria is much shorter, so say, for example, you're saving for a house in the next 3 years, you need to stay in that 1 risk category because you don't have the time that you need in order to benefit from the gains that these accounts can offer. And I know it seems very simple perhaps to some people, but it's so interesting. So even we've touched on pensions earlier. We help people, and again, we have no bias in this because somebody who has a pension scheme through their employment will stay with that pension scheme through their employer, and they shouldn't deviate from that. But knowing that if they have longer in terms of the time in which they're going to draw it down, they should accept more risk. And yet we come across people that are misaligned because they're afraid of losing money. And yet if they've got 20 years, the growth that they should achieve over that time will far outweigh any losses that they may incur. And then on the opposite side of the spectrum, we've got people who are speculating short term, which is madness, And it's not that I'm against investing in cryptocurrency. I was never really big in favor of it because I don't think people fully understood the risks associated. It wasn't just the fact that coins can fall in value. There are other risks, including things like scams and, getting access to exchanges and so on that people probably didn't fully realize. But more so is that they were doing it over a very short period. And trying to invest in a very volatile or speculative instrument over a short period is a recipe for disaster. You see stories sometimes on social media about the successes. You don't hear about all of the failures and the losses. And that's really, really difficult, for people to sort of get grasp on. So again, we talk about kind of portfolios. And I know it sounds a bit wordy, you say, Nick, what do you mean portfolio? But everyone has a portfolio. It could be as simple as a credit union account, but that in itself is what I class as a portfolio, insofar as saying to them, well, look, if you have 10,000 in the bank, and if of that you are prepared to accept risk on 10% of that money, depending on obviously your objectives and so on, then yes, invest in that in a high risk instrument, not specifically crypto. And again, be very guarded about where they put that 1,000, but that's fine in terms of the balance of the overall portfolio. But if you've got 10,000 in the bank and all of it goes into an investment, let's say a fund, an ETF or whatever it might be that you feel is kind of flavor of the day or somebody's trying to convince you of, that doesn't add up in terms of the overall position. And that's the key. And I keep going back to balance. It's so, so important.
Yeah, and it's a very, very important point because I feel like you mentioned the day trading and speculative trading and stuff like that. The reason people jump at it is because the potential short-term gain, the get rich quick, is very attractive. But I've spoken to quite a few people. It's a good friend of mine who'd be very, very clued in when it comes to the trading side of things. I haven't a clue. And he told me, this guy knows what he's doing, and he basically said to me, look, if this was a short thing, if it was get rich quick, everybody would be doing it. Like, there is no guarantees. All you see is the success stories. Most people fail at this stuff. Most people fail when it comes to this short-term speculative,
Absolutely.
potentially high gain, but it's very attractive, and it's particularly attractive to the people that who really shouldn't get involved, who maybe need the extra 10 grand over the next couple of weeks or whatever it might be. This is the way to do it. But based on what you said there, it's absolutely the reverse. Absolutely the reverse. If you need that short term, there's no room for error there. There's no room for speculation. You need to have a solid plan with predictable results. Not something that, potentially you could have 50 grand at the end of the year, but potentially also it could completely remove all of the leverage you have and affect you in the long term, because then you've no way of recovering that.
Totally.
Yeah.
Absolutely.
Which is really scary. We're going to stay on this topic of investment for another minute or two, because I have a couple of questions that came in through Instagram specifically for you. One of them was on investment. I remember seeing it. So you might be able to, I think you've probably half answered the question there, but I'll throw these at you hard and fast here now and see what came up when I put the question box up, which obviously has gone missing on me now. Hold on. So we have, I think we may have answered this. What percentage of net income should one consider having tied up in mortgage repayments? You kind of touched on that before. Oh, sorry, no, mortgage. We've touched on pensions. Sorry, what percentage of mortgage repayments?
So generally speaking, we have this kind of rule of thumb, which is a third, a third, a third. So typically a third of your income should be placed on debt, generally speaking.
Okay.
So the short answer to the question is you shouldn't be spending more than a third of what you earn on mortgage repayment. Now, the banks typically would stop you from doing that anyway,
yeah.
But that encompasses then the car loans and any other loans that you face. And that would tend to be kind of the maximum. And then we say that you should be spending a third of your income on your lifestyle. So these are things like, groceries and everything else that you need to pay for. And then the third ideally would go into saving for all of the various things, short, medium, long-term savings.
Okay.
So that's a general kind of hard and fast sort of ready reckoner. But again, it does vary, and it varies very much from the fact that a lot of people may at the moment not necessarily be saving half enough. And I say to them, you've got to build up slowly. It's back to this analogy of, working out and getting fit, where if you can start on a basis of saying, well, okay, again, this reframing, a lot of clients I come across say, I can't afford to save. We fill in the budgeter. It looks like we have an extra 500 quid a month, but it doesn't happen in reality. And I say to them, well, you haven't done the budgeter correctly.
Yeah.
You need to go back and just revise it. Think about, was there something you paid for? You go down to the local shop and spend 50 quid on a paper.
It's going somewhere.
It's going somewhere. So just do it a little bit more. Now, again, look, we sometimes forget, like gifts, we tend to may give money for birthday presents, whatever, just forget about it.
And your wedding.
And it's always like unforeseens, but you've got to start not planning for them, but you sort of allow for them and say, okay, I have this kind of bucket of discretionary spending. It happens, so I just have to allow for the fact that it's going to happen, because something always comes up. It just happens. So once that's done, I say to them, okay, well, again, if you can put yourself in a position where you can afford to put away, and again, it can start small. I'm not one of these kind of holistic, you should be doing X to get Y. Yeah, I say to my clients, generally speaking, if you ask me how much of my income should I put into my pension, the general rule of thumb would be 10% of your gross earnings. So anyone who's earning 50,000 a year, my advice to them is try and allocate 10%, 5 grand of your gross earnings. Don't forget you're going to get 40% back from the tax man. So it's a net cost of 3 grand. Somebody who's earning 50,000 a year gross, in my view, should be trying to put in 3,000 a year net into their pension. And if they're not, that's okay, but they just need to recognize the fact that, again, as part of this plan, helping them over the course of years, it's really where they're trying to get to. So it's these kind of like ideas, and about saying to them, let me see, can I help you save money? Because typically a lot of the time where we find the money to do the things that I've spoken about earlier, reducing your tax typically costs money. Obviously paying down debt earlier costs money. Taking out a financial product like a savings plan costs you money. Sure, money doesn't grow on trees. So where does that come from? It comes from the ability for us to save money on one side. And that's the balance that we find. So can we reduce the cost of insurances? Can we help you get a better health insurance policy for a lower cost? Do you even need it at all? Is it necessary in terms of where you are currently in your life? And then we apply that, and then we just tweak the model as we go. And hopefully through time and through pay rises and, better lifestyle. It's interesting, not to change the subject, but I was driving home last night and I couldn't understand what was happening. There was a massive queue of cars. This is in Cork City now, by the way. And they were leading to this garage, and I couldn't work out what was happening. And then I realized that they increased, obviously, the excise back to normal on the cost of petrol and diesel. And it was interesting. Like, so people are kind of aware of like how to save money. I just thought it was a really like interesting sort of, analysis of like how determined these individuals were, because the queue was like, it was miles long. I was like, Christ, they're really determined, these people. And I said, if I could sort of capture that almost in a bottle. And
I'd say you were buzzing driving in the road going, go on, people. Yes, we're planning, financial planning.
Absolutely. So they were that determined about that one area just to fill up the car. Now, I'm not knocking them. Obviously, look, it was, very sensible. But, taking that into other areas, and maybe some of them they wouldn't necessarily be as au fait with, because that's an easy one. Like you hear the cost of petrol and diesel is rising, you have to go and fill up your car.
Well, that's the funny one, because there's certain things like the size of a Freddo bar, or a chicken fillet roll, or how much your petrol or diesel cost, that we're all over.
Yeah.
But there's a lot more money on the table for us.
That we just don't realise.
Yeah, we know our priorities lie with the chicken fillet rolls. So, this ties in with the kind of investment as well, cash or assets, which to focus on, and at what stage in life should the balance shift? So should you be focusing on accumulating cash or investing in assets, or what would the balance look like? If there is, I know it's different, depends on situation, etc., but is there kind of a general guideline or rule of thumb you'd use?
Yeah, and I suppose this probably fits into the fact that, there is this kind of, again, sort of rule of thumb that people should have about 6 months of their salary as an emergency fund. And I personally don't profess into that. I say to people, look, ideally, yes, but, typically most things are not ideal, and we need to focus on the things that are important. So bearing in mind that we have this situation, obviously, and it's been like this for a long time, where deposit rates in Ireland have been very, very low. We've been in a low interest rate environment for a long time, which has really benefited, obviously, mortgage holders, and they're feeling the pinch now. And we're also in this situation where deposit rates have been very low. So savers who have had money in the bank have really lost out. And unfortunately, whilst interest rates have risen considerably, deposit rates haven't. And that's a bit of a kind of a dichotomy. And, people are wondering why. The main reason why is that there's not enough competition in the Irish banking sector, unfortunately. And the other main reason is that with the cessation of KBC and Ulster Bank, a lot more money is in the banking system. And therefore, banks don't need the cash, so they're not going to pay for it. So what's happening is that for these individuals that are keeping money in cash, unfortunately for them, it's eroding in value. And what I'm now saying to them is, look, to try and best answer that question, I personally feel that if you're in a relatively secure position where you're going to be paid next month and you're going to be paid the month after, you don't really need to keep this kind of emergency fund. Yeah. Like, it's raining every day when it comes to like trying to plan for the future. So deal with it now and get yourself in a position where you have a relatively low balance for, okay, we get it that something could happen tomorrow that you just need to kind of have a few euros for. But outside of that, you're not going to allow for the fact that your roof could cave in. I mean, if we feel like that, we'll probably never get out of bed, that way. And apply the money there. Now, that doesn't mean it has to be spent, and it could go into something that, as long as it's relatively accessible. So again, I spoke earlier about, having the right vehicles. I say to people, as part of this kind of exercise and planning effectively, you can have money that you can access, but it can still be invested. Now, we have to be, mindful of, what the plan is in terms of what that is required for. And sometimes people don't really know. I speak to people, particularly when they're starting out a journey, and I say to them, look, do you have any intention of buying a property? Maybe. I'm not sure when. Okay, that's fine. At least it's a plan of sorts, but we haven't got it specifically identified. Are there other objectives? And again, you can't predict that somebody might meet somebody and be in a relationship, or you don't predict that people that have kids or whatever, okay, it might be in their sort of psyche, but So how can you start to plan for that? Because it doesn't exist now. Like, I speak to people about putting money away for this kind of longer term, medium term savings. And they say, well, okay, but I haven't specified what I need it for in 5, 6, 7 years time. I say to them, but you might want to change your car. You might want to refurbish a room of the house that you haven't bought yet. And it's all very kind of like, again, it's conceptually just trying to explain, we don't necessarily always know what we're going to need the money for, but we need to plan as if it might happen. And rather than trying to deal with it at the time it happens, it's been on that front foot. And I think for me, the biggest really benefit that a financial planner can give people is that they can almost sort of allow for the unforeseen before it happens. It seems a really kind of holistic view, but having money working for you is probably the biggest thing that most of us probably don't make best use of.
Yeah.
We feel that maybe having money in the bank is a good thing, and it isn't always so. Again, I'm going back to this kind of less than 3 year analogy. Yes, it suits you. And some people say to me, oh yeah, Nick, I've got a lot of money in the bank. I was going to buy a house, but it didn't quite happen. And look, it's been stalled, and interest rates have risen and property prices are still really high. But I say to them, it's in the best place. As much as it pains me to say this, that you're not going to earn anything really. And yes, maybe that money won't be put to use. We can't do anything better with it than where it is now. Had we known and had we been able to plan for previously, perhaps we could have done something. But that's okay. It's useful to know, that suits their particular situation. Again, this whole thing I spoke earlier about, the time that you have, and rather than speculating, and it's interesting, like some people are saying, oh yeah, look, it's a good time to buy into the market. Should I buy shares now? I can see some of the tech stocks, they fell badly last year. Should I buy? I say to them, that isn't really where you should position yourself. And I have a lot of experience. I have an economics degree from the London School of Economics. I've worked in investment banking. I've been a financial advisor for 25 years. And I don't do it. Yeah. And I have the time.
If ever you needed any sort of indication, if you don't do it, I'm not doing it.
And the reason I don't do it is because I don't have my finger on the pulse on a kind of an hourly, minute by minute moment. I have a general sense of what I think is going to happen. And, yes, I'm not saying people shouldn't, have balanced portfolios. I spoke earlier about, this kind of rule. It's funny, I see some financial planners are talking about this kind of 60-40 rule, because it sounds like, it's a buzz thing. I think it came from the States, and like that, I listened to a few people, and there's these gurus. Some of them, look, they have a good message, but I think sometimes it gets kind of miscommunicated or maybe the way it's translated.
Yeah.
And if I said to someone, oh, you should have this 60-40, it basically means that you should have, of your investment portfolio, 60% in kind of risky assets and 40% in more conservative. I'm like, but that doesn't generally kind of add up for most people, because if that's the case, why would you have more than half your money at greater risk and then just about roughly half your money then very low risk? Surely it makes more sense to have all of your money in the right risk category for you, where it's at the sort of same level.
Yeah.
But it's just become this kind of almost like a product that, people now are kind of getting used to. And it sounds probably sexier than a managed fund.
Yeah, and that's what sells. People are attracted to these quick fix, easy schemes that sound good, that sell good. We only spoke earlier on that it's not, every business has to be a marketing business now. And you need something to separate you. You need a USP. You need something different. So if I can tell you there's this new rule, 60-40.
Yeah.
It's a new rule. It's kind of almost like the definition of a charlatan. It's like, we have this secret information. It's all the information's out there. You've just shared most of it with us over the last hour and a half. But if I can tell you that there's this new tactic, it's a new technique, it's a new strategy, and it's called a special name, and yeah, come and work with me, and we'll make all your dreams come true. It sells, so it's attractive to people. So I do get it, but it can be frustrating, I suppose, because I came from the health industry. The advice hasn't changed in 50 years. It's the same stuff, but now you've got new experts saying the same thing in a different way with a different packaging, and it's a new product. Yeah. So it can be frustrating for people, and it's disempowering for people as well, because it's the basics that you want them to understand, and this kind of clouds the waters a little bit, doesn't it?
Absolutely. The other thing I would say to the listeners is, again, depending on the situation we find ourselves, it's generally better than we think. And I know that may sound strange, certainly for people who may be struggling and may feel that they don't have the benefit. But, I talk to them about, where they are. So, I spoke earlier about, understanding where your pension is at. A lot of people's pensions are probably worth more than they realize. Again, you have state entitlement. As well as that, then there's a case of benefits that you may have through your employment that you don't even realize. And when you add these things up, it actually looks better on paper. And sometimes this exercise that I do with people, and I ask them, as I said, to just do one thing, which is to sign the authorization. And we generally tend to suggest that they can fill in the budgeter. Now, it's not mandatory, but it helps them. And when we meet them, a lot of people say, I really benefited from just doing the budgeter alone. Like the review has already been worthwhile because it got them to see where they were and putting it down. And they always say, like, a problem shared is a problem halved. It's like that. It's like saying to them, look, this is where you are and this is where you can end up. And people come away from it saying, okay, yeah, it's not as bad as I thought. It looks more advantageous. And as I said, really what we're trying to do is help people understand that they can benefit themselves going forward. I never look backwards. The one thing I always say to people is forget the past. Sometimes people kind of hang on to it a bit too much. They think about, what they did. They invested badly. They bought a property at the height of the market, in 2007, whatever it might be. It's all about moving forward. And I think sometimes if you keep looking back, it will burn from you. I say to some people, look, your pension fund, I mentioned earlier about the time and invest in higher risk. And then they say to me, oh yeah, but my dad, he had a pension fund and he lost a lot of money and there's no way. And I say to them, look, with the greatest respect, that situation was probably very isolated. It shouldn't have been appropriate for him, perhaps at the age that he was, to be in a high risk fund, because obviously you'd like to think that as you get older, you de-risk because obviously that time is shorter. So intrinsically, you're going to de-risk that. And therefore, what they're doing is, I mentioned earlier about this anchor bias, they're placing their decisions now based on a previous experience or a feeling. Some people, for example, like, again, they might be wedded to, say, the post office. I have no issue with the post office. At the moment, my view on it, however, is it doesn't typically make sense for a lot of people to invest in the post office, particularly in the longer term bonds. The best rate they offer at the moment is a 10-year solidarity bond paying 16%. It's tax-free, and obviously the equivalent is 1.6% per annum. The fact that we know that inflation will be at least 3% per year. Yeah. It's a way of guaranteeing yourself to lose money over that 10-year period. Now, it may suit a certain cohort of people, particularly if you're very risk averse. But for me, I want to at least keep pace with inflation, surely, because otherwise I'm going backwards. Yeah. Now, those rates have moved. They were, believe it or not, about 4.5 years ago, 50%, 50. Can you imagine? What a massive, dramatic change. And last year, they were down as low as 7.5%. So the rate is starting to creep back up. So what I'm saying is, I'm not against the post office, but just do it at the right time. If you hold off for 3 to 6 months, that rate will probably be closer to 20%. And at that point, it might make a little bit more sense. Even though I do feel for that sort of money, it definitely, their 3-year account pays 1%. Credit that. Not per year, by the way, 1%.
1%
overall.
total over 3 years.
0.33%. Now, it's a guaranteed return. Obviously, it's tax-free. But that doesn't entice me in any shape or form.
Technically, it's a guaranteed 2.7% loss or whatever the maths work out is. Yeah.
So you're like, okay, I'm not going to look at those. So it's more about just presenting the options. And as you said, information is power. Yeah. And the key thing really for every listener today is just to know, whilst I know we've touched a lot of subjects and topics today, make sure that the thing you do is do that financial budget once a year. I think it's for everyone, whether you're earning 500,000 a year or if you're just on your first job or even if you're unemployed. It's really important to know like what you're getting in from the state or from an employer and what you're spending it on.
Where can people access that financial budget?
It's available on our website, which is alphawealth.ie. It's very, very simple. It's a free calculator. There's some really good webinars as well. Again, not to plug them, but they're
plug away, my friend.
Easy to access. We do kind of 30-minute webinars. They're all complimentary. We do them typically twice a month. We're having a break now for the summer, but we will restart them in September 23. And there's some really good videos. I talk about, how to save 30,000 over 4 years. So what I'm doing is I'm just taking that subject of savings and showing people like specifics as to how. Now, obviously, that isn't relevant to everyone. Some people don't need 30,000. Some people can do it over a longer or shorter period. But it enables them to kind of envisage. I talk about myself in terms of my path. I mentioned earlier, I'm in a blended family. I've been through a lot of the financial, I suppose, hardships and, situations around dealing with ex-pension schemes to trying to help build and grow savings, my own pension fund that I talk about on some of these webinars. And I think what it does is it enables people to actually kind of see their own situation, because I think unless they can envisage themselves, it's very, very difficult.
Yeah.
I try and do that. And then there's specifics, like example, we did a webinar there recently for teachers, because a lot of teachers, because they're part of this kind of like public state body, their pension schemes are slightly different to ordinary pensions. And there's a real misinformation around like buying back years, for example. Now, not to get into too much jargon, and all we did was we just did a simple video trying to make it very easy to explain and understand. I spoke earlier about the UK pension and the opportunity for people. So the best way we felt that we could explain that to them is to encapsulate it in a 30-minute video. I think people should allow themselves, whether it's driving home from work or indeed just, pop it on in the evening and just put it on the background, but to make it meaningful for the area that they're specifically interested in. Now, some of them are specifically based around reducing the tax they pay. So we focus and hone in on that tax scheme that I spoke about, the ESS scheme, and then pensions, and really about the dramatic effect. I mentioned that I have a very specific plan about 60 and showing people how they can go from A to B.
Yeah.
And navigating it without going to C first, and then over to D, and then coming back to B. And it's just putting you on that sort of playing field and pointing you towards the goal.
Nick, because my last question was going to be about a toolkit, which you just covered it beautifully there for people who are listening at the moment who may not know where to start and feel a little bit overwhelmed by a lot of information you gave there. It's all fantastic information. So step one, re-listen to the podcast and go through it again. But start with this fact-finding mission. Where am I right now? And I like the advice you gave about forget about the past, because this is an emotional thing. And a lot of the times we can become very discouraged enough so we don't even move forward based on where we are in the past. And again, we keep bringing it back to this health and fitness journey. Somebody who tends to be maybe unhealthy or overweight, there's no motivation for them to go forward. But where you are right now is where you are right now. It doesn't matter what happened in the past. All that matters is the decisions you make going forward. So using the budget tool, potentially reaching out and working with a financial advisor, consultant like yourselves, just gathering that information and empowering yourself and putting a plan in place, no matter what that looks like. And again, as you said, whether you're unemployed or you're making €1 million a year, it doesn't really matter. It's the same concept, it's the same principle, and everybody can benefit from this information. Are you available at the moment for people to reach out, people to work with you, people to ask you questions?
Absolutely. Like, we've got a really good team in Alpha Wealth. We're a company of 10. We've just thankfully taken on 2 new people. And we have qualified advisors. Primarily, it's myself and one of my colleagues, David Looney, that we work with the clients. I feel very conscious that I don't want people to feel that they're being passed off to someone. I'm very hands-on. I want to work with individuals. And if anyone wants to have a specific review with me, just contact me directly through our website, or indeed you can get in touch through my email, which is very simple. It's just nick@alphawealth.ie. We have a charging structure where typically we charge a maximum of $199 per financial consultation. We are reducing that to €99 for any listeners. Just reach out and just remind me of that. We can send you the code. But no person who comes via this channel will pay more than €99 for the financial consultation. And just explain, that's an all-in fee, which encompasses that financial review I spoke about. We put together that spreadsheet. We help you understand your, I suppose, financial objectives, how to achieve them. And all future information that we provide you is completely free. Now, if anyone does have any specific questions and they just want to email me, absolutely, please feel free to do so. There is no cost whatsoever. Now, just to put it in context, and again, just so people understand, a lot of financial advisors are charging, I've seen figures, believe it or not, of like 300. I saw one financial advisor charging €1,000 for a financial review, which, with the greatest respect to them, I just fear that the purpose of why people should do this is to get enough value. And the fee that we're charging really is, in my opinion, giving us, I suppose, the opportunity to kind of show where we can provide value for people. And it doesn't always stop there. So if you say, Nick, okay, is that the only fee that people, financial advisors charge? Not necessarily. So if you said, okay, but we need to fully understand that. So what we're saying is that the €99 fee captures everything that I've spoken about today, giving you the guidance, the advice, the financial plan, and helping you in that journey. And you can reach out to us 20 times over the next 5, 10, 15 years, and it's all encapsulated within that. However, if there are any financial products that are purchased through Alpha Wealth, and again, as an independent broker, we'll be very, very cognizant of keeping fees down to an absolute minimum. We may receive a remuneration from the provider that the product is placed with. Now, again, as a regulated entity, we need to be very open and disclose the fees that we receive, and they are obviously then presented to you. The system in Ireland typically is that the consumer doesn't see the fee. It's like taking out house insurance. The broker that you probably did that with would have been paid a commission, but you pay the monthly fee for the policy. And it's the same in the financial services industry. So typically the costs are borne through the product, the financial advisor benefits, but it has to make financial sense to the individual. Now, again, I'd like to suggest very strongly as an independent broker that we are a low-cost company. We've never, ever been found wanted. And someone said to me, actually, funny enough, a few months ago, farm don't kill. It's about working with our clients. It's about trying to build up that relationship and making sure that there's a longevity. And all I would say is that for me, I feel very, very strongly, having come from an industry, as I said, where I was working in the banks, where it was a case of just trying to sell everything we could at the highest rates we could possibly sell for. We're really, really discursive. And the unfortunate thing for a lot of people is they're paying more for products that they currently have than they need to.
Yeah.
So the one big advantage, I suppose, for anyone who's listening is either email me for questions or book in for a review, the €99, and I guarantee you'll save significantly more than that. I've never met a client that we haven't been able to help, and it may be something very, very specific to them, or it may be something that may help them in the future. But there's so many different things I think that there's so much of an opportunity for.
Considering the potential gain available for people, most people listening here, I think €99, and thank you very much for the reduction, but €99 is absolutely money well spent. In this particular case, Nick, there's loads of other areas. I'm not going to go into them now, but I am going to ask you to come back and join me again at some point, because there's lots of specific areas I'd like to go a little bit deeper on. But I think you've given a really, really good overview there. There's periods of that conversation I was getting a bit overwhelmed, but then I was like, well, this is a good thing. This is empowering, because if I'm getting overwhelmed, it means these are things I don't really think about a lot, and it's important to have them in my purview. You've definitely brought things to life for me. I know I can speak for the listeners as well. So thank you very much for your time. Thanks for your generosity today. And look forward to chatting again soon.
It's a pleasure, Dan. Thank you so much again. And I do appreciate the time that you've given me. And as I said, I'm very passionate about finance. Obviously, you're very passionate about what you do. I think that's the key thing, is that you just, having an interest. And it doesn't mean that you have to have interest if you're dealing with us. Just let us do that for you. We really enjoy what we do. It's funny, my wife, she's joined us in the industry, and she brings this kind of, I suppose, sense of realism to the fact that she's not from a financial services background. She's a really good kind of farmer. And, we've taken on board a lot of the things that she's said and brought to the table. And it's just given us that kind of extra edge to make it meaningful to individuals, because, it's things that products she never understood before, or, this phraseology, and just trying to remove that, because, it's I think that there's huge opportunities for people. I really do. And as I said earlier, everyone can achieve financial independence. We just have to set the goal and basically steer in the right direction.
I love it, man. I love it. On that note, thank you again.
Thank you very much, Dan.
I'll see you next time.
Cheers. Thank you.